The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and a warm welcome to all. I am Ridul Mishra and on behalf of Care Ratings welcome you to a live webinar on housing finance industry, most resilient asset class amidst pockets of vulnerability. Care Ratings sincerely appreciate your time in joining us for this webinar. To take you further on this, may I introduce our speakers for today. We have with us Mr. T. N. Arun Kumar, Executive Director, Care Ratings Limited. Mr. Arun Kumar, CFA, FRM, has over 27 years of experience in credit rating and project appraisal and has extensive knowledge about the functioning of the corporate sector. Our second speaker for today is Mr. Ramadasu Bandaru, Associate Director. Ramadas is part of the securitization team. Our third speaker for today is Mr. Abhishek Gupta. Abhishek is working as Senior Manager at Care Ratings Limited and is part of the BFSI ratings. I would like to inform that the discussion will be in form of a presentation which is visible on your screen. In case of queries, please key in the questions in the slot provided. Our speakers would take the Q&A session at the end of the presentation. May I request Arun sir to begin the session?
Thank you, Mradul. Good afternoon to all. Thank you all for joining us on this webinar. This is actually pursuant to a study undertaken by Care Ratings in the HFC sector, which gave us very interesting perspectives. This study will be available, is available today at our website, careratings.com. You are free to download the same. Today we will be covering a broad spectrum of issues pertaining to the Indian housing finance industry. We'll be covering the housing finance companies that have expanded the market share in the recent years. Specifically, we will be presenting our detailed analysis of home loan segment of HFCs. In light of the strong growth witnessed by HFCs in recent times, we feel this is the right time to evaluate the performance of the industry and understand the nuances of the business strategies adopted by various players. Housing loan sector has undergone a phase of very high growth in the recent years. Increasing urbanization has led to higher demand for housing and greater focus on financing options available for home loans. Government focus such as Housing for All by 2022 and its push for affordable housing has also propelled the growth in the segment. The current union budget announced the creation of a dedicated affordable housing fund under National Housing Bank funded by PSL shortfall and approved bonds. Further details are not available here, we expect that this will meet the funding requirements of affordable housing in the near future to a large extent. Banks have been traditional financiers for housing loans. However, with specialized lenders such as HFCs establishing their expertise, the market share of banks has been shrinking in the recent years. In fact, the number of HFCs registered with the NHB has increased to 92 as of December 17. This is up from 64 in June 15 and 75 in June 16. Two things are clear from this graph. The growth rate of housing finance portfolio has always been higher in the HFCs than in the banks over the last 5 years. It is observed that the growth rate both in the housing loan segment of HFCs and the banks has moderated to its lowest level in the past 5 years in this year, in FY17. We believe that demonetization and the introduction of Real Estate Regulation Act, RERA, have impacted the housing loan market and has been responsible for this. My colleagues, Mr. Ramadasu and Mr. Abhishek, will take you through the detailed presentation. Handing over to Ramadasu.
Thank you, sir. Good afternoon to all. Our approach to the topic is based on our study of the financials and businesses of 30 HFCs. Based on the size of AUM, we have classified these entities into 3 categories: large, mid, and small. As per our categorization, 5 large HFCs, each with AUM exceeding 40,000 crore, have a cumulative AUM exceeding 7 lakh crore, accounting for 84% of the total home loan industry AUM. As per our classification, 10 HFCs are categorized as mid-sized with individual AUMs between 5,000 crore and 40,000 crore. and cumulative AUM above 1.1 lakh crore, comprising around 13% of the industry. Another 15 HFCs are categorized as small with AUMs below 5,000 crore and cumulative AUM exceeding 20,000 crore. These 30 entities cumulatively comprise 98% of the total housing finance industry. During FY14 and 17, AUM of small and mid HFCs have grown at a CAGR of 70% and 30% respectively. However, the market share of large HFCs has only marginally declined by 2% during the same period. Due to increasing NPS in their corporate book, banks have shifted their focus to retail lending, primarily home loan segment, and emerged as a reliable option for HL borrowers. This has led to home loan segment becoming increasingly sensitive to interest rates. Due to intense competition from banks and in order to maintain their portfolio growth and protect their margins, HFCs have focused on high yielding non-HL book. Non-HL book comprises LAP and corporate loan book, including construction finance, lease rental discounting, and other corporate loans. LAP loans are backed by mortgage of property where end use of funds is either business or personal. The yields on such loans are high while the LTV is lower, giving HFCs better margins. Majority of the underlying properties are self-occupied residential units, which further reduces risk exposure. The LAP book was 38% of the total non-HL book in FY17 for HF industry. Corporate loan piece accounted for approximately 61% of the non-HL book in FY17. HFC's non-home loan portfolio grew by 25 to 30% of the overall book during FY14 to FY17 as compared to home loan book growth of 19% year on year. This segment has grown faster with almost 28% year on year growth in FY17. In FY17, the share of non-HL book was similar in the large and mid HFCs, while the proportion of corporate loans, primarily builder financing in large HFCs, is high, that is at 20% of the AUM. LAP formed the bulk of the non-HL book in mid category, that is 19% of the AUM. We now analyze the home loan portfolio of HF industry more closely. For this, we have collated data based on 4 broad parameters: borrower profile, loan to value ratio, loan amount, and geography. The borrower profile depicts the categorization of borrowers based on their source of income to fund his housing loan repayments. Thus, a borrower could be salaried or self-employed. Overall, the salaried class constituted approximately 65% of the home loan book. The HL portfolio of salaried segment has historically witnessed very low delinquencies as compared to self-employed segment. This has resulted in competition from banks that have shifted their focus to retail loans amid high delinquencies in their corporate book. The mid and small HFCs are unable to compete with banks, and large HFCs on account of their higher cost of fund and are thus focusing on self-employed segment to grow their book. The profile of salaried borrowers also differs across HFCs. Small HFCs have primarily extended loans to borrowers having employment in informal sectors, including those who receive salaries in cash, having relatively weaker credit profiles. For HFCs that are lending to individuals without documented proof of income, changes in demography and competitive scenario will continue to pose challenges. These HFCs will have to keep evolving their business models and refining their credit appraisal practices. A critical element of credit appraisal practice for self-employed borrowers include an assessment of borrower's business and ability of the local underwriter credit appraiser to gather data and arrive at cash flows. Care ratings observes that the delinquencies for self-employed category are nearly 3 times as compared to those for salaried category. This could have a negative bearing on the asset quality of players with focus on self-employed segment. In terms of LTV, large HFCs portfolio comprises with, with high LTVs due to salaried borrowers constituting the majority of the loan book. On the contrary, small and mid HFCs have over 35% of HL portfolio with an LTV less than 50%. Due to their exposure to self-employed borrower segment, these HFCs have tried to mitigate the risk by offering loans at lower LTVs. Small HFCs have a high proportion of low LTV loans as these entities provide finance for a significant number of self-construction properties where land value is taken into account for calculation of LTVs. Care ratings observes that delinquencies are higher in loans having LTV more than 80%. Our analysis of the composition of HFC portfolio based on loan amount classification shows small HFCs having a higher share of loans up to 10 lakhs in their book, largely due to their focus on the outskirts of metro cities and towns. The proportion of higher ticket size loans is greater in large HFCs because of the areas they operate in. An analysis of delinquency levels by ticket size showed 90 plus DPD to be highest in the ticket size of less than 10 lakh, that is at 0.9%, as against the industry's HL portfolio average 90 plus DPD of 0.5%. With small HFCs primarily focusing on sub 10 lakh segment, delinquencies for them are expected to be high. The lowest 90 plus DPD levels were observed in 20 to 50 lakh segment with a ratio of less than 0.35%. Geography. Around 75% of the HFC's book is spread across 5 states: Maharashtra, Tamil Nadu, Delhi, Karnataka, and Andhra Pradesh, Telangana. High population density and property prices in urban areas are crucial factors leading to large HL portfolio in these territories. However, these areas comprise only 30% of India's population. The next phase of growth in HL segment would depend upon the government's focus of housing for all and pace of economic growth and urbanization in the remaining states where 70% of the population resides. The share of states like UP, Madhya Pradesh and Rajasthan is small. However, the home loan portfolio has grown significantly in past 3 years. Amongst the big five, Tamil Nadu and Delhi have higher delinquencies as compared to industry average. Care Rating believes HFCs in affordable housing space operating in areas with lower competitive intensity will have better asset quality as they are able to choose their customers. We now move to our analysis of delinquencies in HFCs across categories. The gross NPAs for large HFCs have been stable with ratio of 0.7% for the past 4 years. However, the NPAs have shown an increase in trend for mid and small HFCs. The gross NPA percent for mid HFC has increased by approximately 20 bips in 3 years to 1.2% by FY17. For small HFCs, excluding one HFC having a rural focus, the increase has been around 40 bips for the past 4 years, with a gross NPA ratio of 1.4% by FY17. Considering the fact that the AUM of small HFCs has grown at a CAGR of 70% in the same period, delinquencies calculated on a lag basis would be as high as 2%. For the HFC industry, the delinquencies in the non-home loan book are higher as compared to home loan book. The higher contribution of non-performing assets from this segment has led to overall gross NPA ratio of 0.9% as compared to GNPA ratio of 0.6% in the HL book as of March 2017. We have used 90 plus DPD of care rated securitized pools as an indicator of likely end delinquencies in the future. The pools comprise of contracts originated by large HFCs. It is to be noted their DPDs have remained sub 1% after substantial amortization, that is at around 90% for some of the pools. For large HFCs, care rating expects gross NPAs to continue near current levels and the delinquencies to stay elevated in the medium term for both small and mid HFCs. Before we present our analysis on the profitability of various HFCs, we will touch on the leverage levels seen in the industry. The current regulations permit lower risk capital to be provided for housing loans by HFCs. Due to this regulatory arbitrage, HFCs are able to leverage more as compared to NBFCs. Large and mid HFCs gearing levels are at around 8 times as compared to small HFCs, which have a gearing level of 4.5 times. Gearing levels of large HFCs has remained at a similar levels for the past 4 years, while the same for mid HFCs has increased from 6.2 as an FY14 to 8.4 as an FY17. As an asset class, HL as a product has historically seen the lowest delinquencies. However, higher gearing levels for HFCs operating in affordable housing space might not be an appropriate strategy given that credit losses are expected to be higher. I now hand over to Mr. Abhishek, who will take you through profitability of HF industry and our analysis of various business models and emerging trends.
Thank you, Ramadasu. We will now discuss our understanding of the rota chain of various categories in the HFC industry. It has been observed that NIMs, that is net interest margin, are lower for large HFCs as compared to that of HFCs in the mid and small categories. For small HFCs, the yields are higher as they cater to a high proportion of borrowers with no previous credit history, self-employed by occupation, or tend to have no documented proof of income. For mid-category HFCs, the customer mix comprises a relatively high proportion of salaried HL borrowers, that is, 60% of the HL portfolio, resulting in lower yields. In order to protect profitability, mid-category HFCs have expanded their product offerings to include non-HL products such as LAB, which carry high yields and are mostly given to self-employed borrowers. As a result, self-employed borrowers constitute approximately 50% of the overall book for mid-category HFCs. Large HFCs have been able to maintain the yields by changing the composition of the portfolio and further diversifying into corporate lending. The present competitive environment for retail mortgage lending has prevented the adoption of risk-based pricing practices in the industry. This irrational exuberance is leading to competitive pricing and may hamper HFC's ability to absorb future credit losses. Currently, there is some variation in rates on loans offered to different borrower profile, that is salaried or self-employed. However, Care Ratings is of the view that HFCs operating in highly penetrated urban centers have had limited success in risk-based pricing. It is only those HFCs that operate in low competitive areas that are able to price the loan based on the risks involved. Stable operating performance and a benign interest rate environment have helped in lowering the cost of funds for HFCs in the past 3 years. However, any savings in the cost of funds by HFCs has been offset by the reduction in yields in the HL segment due to stiff competition from banks, thus resulting in shrinking of NIMs. High NIMs for small HFCs is also on account of low leverage levels, which is expected to moderate as leverage increases for the small HFCs. Other income is mostly attributed to processing and other charges, cross sale of financial products, and treasury income. Large and mid HFCs are not able to levy high processing fees due to competitive environment in the HL segment. Some large HFCs derive a significant proportion of their other income from active treasury operations. The processing fee for small HFCs vary from 0.5 to 1.5% of the disbursed amount due to their borrower profile. Ticket size and borrower profile are the key determinants of operating expenditure, that is OPEX, for HFCs. Large HFCs are able to take advantage of the process automation and economies of scale to minimize their OPEX. The OPEX ratios of mid and small HFCs are relatively higher due to A. High concentration of self-employed borrowers who require more due diligence and appraisal checks as compared to salaried borrowers. And B. Target geographies requiring large feet-on-street teams, more so for small HFCs. For HFCs in the growth phase, the OPEX will remain high due to deployment of additional resources required to achieve the targeted growth. OPEX may rationalize once growth moderates. Adoption of technology and automation will be a key determinant in improving the efficiency and profitability going ahead. Credit costs for small HFCs are high as compared to other categories due to their exposure to risky borrower profile that are more susceptible to any disruptions in the economy. Going forward, K Rating expects the credit costs for large HFCs to continue to be at the current levels, while the credit cost for mid and small HFCs to be higher. Irrespective of the business model adopted by the various HFCs, interestingly, the ROTA is currently in the same range across the categories. OPEX and credit costs are expected to be key determinants impacting ROTA, as the interest rate pricing is likely to remain competitive. For small HFCs, credit costs may increase due to their exposure to weak borrower profile. Therefore, it is imperative for small HFCs to rationalize their OPEX or continue to rely on other income to maintain their ROTA. HFCs have adopted various business models to suit their requirements in terms of organization structure, origination, credit appraisal, and collections. Some have adopted a high cost, high revenue model, and some have chosen low cost, low revenue model, while remaining have adopted a mix. HFCs operating in under-penetrated regions have better pricing power. However, they also have higher operating costs as these HFCs require more employees for their operations. On the other hand, HFCs operating in metros or large cities have a lower cost base but also have to offer competitive rates in order to grow their loan book. We will now discuss the different strategies for origination employed by various HFCs. Large HFCs source applicants via tie-ups with builders, their own sales force, and also through DSAs. Large HFCs are also able to get applicants online due to the branding power. They have designed systems where prospective borrowers can fill in to apply for loans online. Other HFCs have to rely more on DSAs, referrals, and on through their own branch network. A local presence is a necessity for origination. HFCs operating in smaller towns typically will also have a large proportion of borrowers in the self-construction category. Hence, HFCs could also have tie-ups in the local ecosystem, such as stores selling construction material from which leads can be generated. The above results in a substantial difference in the AUM per branch of large HFCs as compared to of other HFCs. On the credit appraisal front, the borrower profile is the factor that differentiates the model followed by the HFCs. Large HFCs have a high proportion of salaried class borrowers who have documented income and bank statements. Large HFCs often have designated credit processing centers which do the appraisal of applications received from branches in a particular region or network. Branches would be responsible for the field investigation. However, the credit officer may not be required to have a direct interaction with any applicant. On the other hand, HFCs targeting self-employed category or those having capped salaries have to follow a more rigorous due diligence process whereby it would be necessary for credit officers to have a personal discussion with applicants and employers to understand the applicant's ability and willingness to repay loans. Hence, the branches of these HFCs would also have a credit officer who would make a recommendation which is then acted upon by the credit team in the regional or the head office. We now move to collections. ECS or NASH is the dominant form of collections for all HFCs. However, it is to be noted that mid and small HFCs need to have a high level of interaction with the borrowers in case of any delay. The borrowers are often those whose cash flow can get disrupted due to business conditions. Hence, for any missed payments, the collection officer would generally be required to meet the borrowers to get a better understanding of the situation and to determine their willingness and capacity to pay. For HFCs who operate in the semi-rural or the rural regions, understanding the cash cycle of the borrower is even more important, as taking possession of the property is not very useful due to the lack of saleability of these properties. The past few years have witnessed the emergence of private equity funds and institutional investors pumping money in construction finance through structured deals and mezzanine financing. Care Ratings expects this route to gain more acceptance as a result of the regulatory changes like VERA. Though this may be in direct competition to large HFCs, the huge funding requirements would make it possible for both sources of finance to coexist. Historically, prepayments have been in the range of 1 to 1.5% in the housing loans. However, CARE expects the rates to be higher for HFCs operating in the affordable space as compared to HFCs and banks, as other HFCs and banks are expected to target the borrowers who have established a regular payment track record. With respect to the new trend among affordable housing companies, Care Ratings has observed that in recent times, HFCs have expanded the lending operations in the periphery of the large urban areas and small towns. The marketability of any repossessed properties in these areas is yet to be tested. Lower than expected realizations from any repossessed property combined with weak credit profile of the borrowers may lead to high credit losses for the affordable housing HFCs in times ahead. With this, we conclude our presentation. I now hand over to Mradul.
Thank you, Abhishek, Ramadasu, and Arun sir. Dear participants, now we'll be taking a break of 2 minutes before we come back to take your queries. You are requested to please start keying in your questions in the slot provided. I repeat, we'll be taking a break of 2 minutes before we begin our Q&A session. You can please type in your questions in the slot provided. Thank you. Hi participants, now we'll be opening the floor for questions. The first query is from the line of Mr. Ankur Shah is asking, do you think there will be consolidation in this space?
Hi Ankur, thanks for the question. The industry has a high number of players, but the penetration of credit to fund house purchase is very low. Several surveys have pointed out that Indian mortgage market as a percentage of GDP is very low. So these two trends of increasing penetration and consolidation will likely influence each other in times ahead.
The next query is from the line of Mr. Dinesh Kaushik is asking, which are top two companies in large, small and medium segment?
Hi Dinesh, from large category HDFC and LIC.
India Goods.
LIC are the biggest. From the medium, Tata Group are the biggest. In small, Mahindra and Aspire are the two biggest.
The next query is from the line of Mr. Vinay Kedia is asking, he's asking two questions. The first one is, can housing finance companies provide loans to corporate for uses other than house construction purchase? The second query is, NIM equals interest income, interest cost. How is interest cost determined for housing finance companies?
Yes, the HFCs give loans to other than construction finance. There are some of the HFCs that are active in giving loans to corporates. And second question,
For the calculation of the interest cost, it's basically the interest expense over average borrowed funds over the year. Please note that we actually calculate the entire, the ROTA chain on average total assets. Although the NIM, when we talk about net interest margin, we're basically talking about interest income less interest expense over average total assets, which is separate from cost of funds when which is specifically asked, which is basically interest expense over average borrowed funds.
Amit Rai has a query is asking, is there any breakup with respect to funding towards under construction properties? I'm sorry, Amit, we don't have this. The next query is from the line of Mr. Raghav Khandelwal is asking increase in interest rate by RBI in coming fiscal policy, how it will impact HFC business.
Thanks for the question. See, as we mentioned in the presentation, that HFCs are unable to price their loans accurately due to the competitive intensity in the segment. Hence, for any incremental increase in the borrowing cost, we do not expect that the HFCs will be able to hike their EMIs. Thus, a moderation in NIMs could be expected.
Uh, there is a question from Mr. Amol Pawar. What is it?
Can you read?
Can you rate individual HFCs and
Can you rate individual HFCs and publish their reports? Yes, we do have a portfolio of 37 entities outstanding ratings. So we have all the reports which are available on the website. So you can go and browse that. You will get it, the data. And the second question from Mr. Amol, has higher lap in HFCs is a disturbing trend? We cannot say like it is a disturbing trend, higher lap. Yes, we have seen the delinquency levels are high marginally as compared to home loan, but these all are HFCs. These all HFCs are giving mostly to salaried class, and their funding for self self-occupied properties. So as compared to commercial property, self-occupied properties and residential and self-occupied properties have shown low delinquencies. So many years these entities are doing it, but no delinquencies has increased in this particular segment.
The next query is from the line of Kankshit Munshi is asking also with the increased competition from PSU banks and large private banks, would consolidation, teaming up, joint lending, etc. evolve?
Mr. Kaushik,
Kankshit.
Kanchit, Mr. Munshi, we have already taken up the consultation question, and on the joint lending thing, like already the HFCs and banks try to achieve, but due to the different credit appraisal practices and different internal legal teams, they're not able to achieve on the same page. So not much progress happened in this particular joint lending concept.
We have a query from Mr. Albert De Costa. He's asking what percentage of housing loan portfolio for mid and small HFCs has been securitized when compared to the other large HFCs.
Thank you for the question, Mr. Albert Da Costa. So, for the overall industry, so 8% is securitized, and for the mid, the securitized book is 3%. For the small, the securitized book is 4%. For the large, it is 10%.
The other query of Mr. Albert De Costa, is there a major tenure difference in the average loan portfolio between the large and mid-size HFCs?
Thank you. One more question from Albert Di Costa. Uh, uh, this again, like it is a profile changes everything. So the profile for salaried, so banks, HFCs, whoever are there in the industry, like that they give up to 25 years maximum. But the same for mid. So for self-employed, they give not more than 15 to 18 years. So in this case, so large containing mostly large mostly operate and salaried class. So their tenures go up to 25 years. For mid size, above 50% is self-employed. So their tenures go up to mostly 18 years.
The next query is from the line of Mr. Ravi Kumar N. He's asking, are banks that are lending to housing finance going to take market share from non-banking firms like Greg, Canfan, Homes, Muthoot, and Manappuram, etc.?
As we already discussed, it is depend upon player to player, which player is operating in which category. Like someone is only affordable, someone is mixed. So particularly in salaried class and established where credit history, some credit history has been established. In those cases, we have been observing already the prepayment levels are very high for HFCs, but in case of affordable housing segment, affordable housing players, for banks, it is not easy to go and find the borrower and do credit appraisal. So it might not be easy from the HFCs to take in the medium term, but over a period of time, when the same borrower who is in affordable segment, if his credit history is being built up and is being very good, so banks might try to take up that loans. So that is we mentioned in the report.
Uh, yeah, we have a query from Mr. Ravi Kumar. Is asking whether he can we can send the seminar or it's available offline for viewing. Mr. Ravi Kumar will be sending you the link of our uploads where all the presentation and this particular section also will be uploaded on YouTube. So I'll be sending across to you. You can please write to me at cop.com@careratings.com. For the other query coming from Mr. Albert De Costa is asking what other income treasury strategies are the large players adopting?
Uh, uh, these large players are able to make very good other incomes. So that other incomes in that other income, treasury income is one of the important. And other than treasury income, some of the large HFCs are doing uh, loan syndications, and they're earning money in consultancy services. uh, these are some of the things like they're earning.
The next query is from the line of Mr. Jihan. He's asking, does an independent HFC company have advantages in borrowing rates, CRAR, etc., vis-a-vis the diversified NBFC? What are specific advantages for a financial services company to have an independent HFC company?
Hi, thanks for the question. See, there are two parts to it. One, the HFCs who are under the NHB umbrella, they basically have risk weights to the loan portfolios which are lower as compared to other asset classes. That is, what I mean is a housing loan would carry a lower risk weight as compared maybe to a CV loan which an NBFC might give. There, actually, the HFCs are able to gear up more as compared to NBFCs because of the regulatory differences. Second, what the HFCs also have an advantage is of refinancing availability from the NHB. These are subject to certain guidelines and certain criteria to be met by the NHB, but this also helps them in lowering their borrowing costs.
The next query is from the line of Sundara Murthy. She's asking, what is the market share of affordable housing project taken by HFC?
What is the market share? See this. What is the definition of affordable housing? Like it depend upon the geography, depend upon the location. Basically, that affordable definition itself changes. So if you stay in Mumbai, like for 30-40 lakhs also, you call it as might be affordable. But if you go to small town, you have your own land, like so 5-6 lakhs you can build a home. So based on but what we can say is, like across the industry, if you say less than 20 lakh loan, some of the people, like in some of the industry estimates compares less than 20 lakh loan is the affordable housing. So that less than 20 lakh share would be around 30% of the overall industry.
The next query is on the line of Ankit Agarwal. Is asking, in order to calculate ROTA, have we adjusted the leverage of at the same level?
Hi Ankit, regarding the question, I just need to let you know that when we calculate ROTA, leverage is actually taken care of. Uh, for example, two companies having same metrics but one with a high leverage with the same lending rates will definitely have a higher cost of borrowing and hence a lower NIM. Hence, we use ROTA as the base indicator for profitability as it already encapsulates the leverage part of it. We do not need to adjust any portion of leverage for it, but it is already taken care of.
The next query is in line of Kanchit. He's asking, as per the presentation, the OPEX for small HFC is minus 3.5. Can you kindly explain what expenses constitute this number? Also, what is the weightage of each constituent?
These operating expenses generally includes all management expenses, sales expenses, salaries of employees, collection, operate, operating expense, basic operating expenditure, all other operating expenditure, uh, and this is
Excluding of provision.
excluding of provisions.
The next query is from the line of Sundara. She's asking, there was a report which says that there is a high percentage of NPA in loan category below 5 lakh. Can it affect the HFC performance?
Hello. See, we have actually, the report which you're referring to, we have also made similar conclusions in our report. We basically focus on loans, categorize them below 10 lakhs, whereby we are looking at a gross NPA ratio of 0.9%, which is higher than the overall portfolio. We do believe that yes, given this fact, one of the conclusions which we are drawing is that the credit cost of small HFCs is expected to be higher going forward.
The next query is from line of Mainak Chakraborty is asking what is prepayment percentage we can expect on total portfolio for mid and small HFC in future.
Hi, the prepayment rates have actually been varying from player to player. In some cases, we've actually seen that the prepayment rates have even been up to 2% on a monthly basis. However, in some small HFCs, it is actually in the median range. But however, generally, as the trend, we have observed that the prepayments are actually higher for the smaller HFCs.
Arun can answer that question.
On the query of Mrs. Sundara Murthy, she's asking about the PDF of past seminars. Sundara it's all uploaded on our website, and plus you can write to us also at coop.com at kratings.com. The ID would be reflecting in your feedback box as soon as the webinar ends. And the same answer would apply to Mr. Ravi Kumar also.
कुछ मेंशन नहीं किया डेडिकेटेड अफोर्डेबल हाउसिंग
The next query is on the line of Ujjwal. Abhishek is asking, is the fund allocated for affordable housing is only for rural housing or it is for urban and rural both in the recent budget?
It is for both urban and rural.
The next query is on the line of Ranganathan Subramaniam is asking, how do the cost income ratio of the big, medium and small HFCs compare?
Hello, the answer to your query is as follows. For small, it is about 24%. For mid, it's about 11%. And for large HFCs, it's about 5%. Please note that when we tell you the cost to income ratio, we are actually excluding the provisions from this. This is generally OPEX over net interest income plus other income.
I guess there are no questions coming in, so probably we'll be ending this Q&A session. Thanks again to all participants for taking a time out and being a part of this Care Ratings webinar. We hope the discussion was insightful and look forward to your participation in future also. In case of any queries, feedback, suggestion, you are please welcome to write to us at corp.com@careratings.com.
Yes.
The feedback box along with the email ID would be coming as soon as the webinar would be coming by email to you as soon as the webinar ends. All our transcripts and recordings of the webinar are uploaded on YouTube channel, Care Ratings YouTube channel. You can refer to that. In case of any specific data queries, and again you can write to us at corp.com. And our report also on housing finance, as Arun sir has mentioned, is available on the website. For any specific queries also, you can write to us for that. Thank you again, and that's all for now.